Well, the bluntest put-down of Joe Hockey's bank plan came from ANZ chief Mike Smith, who likened the shadow treasurer's economics to those of Venezuela's socialist president Hugo Chavez. It's been a busy week for Mr Smith. Not only did he have a politician or two to rough up, he put out the ANZ's annual profit, up an impressive 53% to $5 billion. I spoke to Mike Smith at his Melbourne HQ. Well, Mike Smith, you really got stuck into Joe Hockey this week. Politicians always complaining about interest rates and warning banks not to put them up in advance of the Reserve Bank, which is kind of what he was doing. But you called him Hugo Chavez. So that was a bit rough, wasn't it?
Well, I think we have to put things in context. Yeah, you're right. I mean, politicians are always going to have a go, and I accept that. You know, that's part of the environment. But no, what happened there was, this idea of actually imposing interest rate regime, really looking at further regulating the banking industry and really taking it back to an era that has long since gone.
Yeah, well, he later then said he didn't actually say that, or didn't. If he
well,
said
I heard
it,
him say it. Yeah. He said it pretty clearly, but. Look, I mean, then he came out with this plan and whatever. I mean, it was all rather strange stuff, and it was just very anti-reform. I think what I was trying to get to here was not so much about the bank as the overall economy. The success of the Australian economy over the last 20 years really is a credit to the reform agenda that has been driven by successive governments, both Labor and Liberal. And we must keep that going because that is critical for the future growth of Australia. So the issue I was trying to make was actually the economy needs further reform. We require continuing to open and to use a market economy.
Just moving on to your result now, 53% lift in profit looks fantastic, except that of the $1.5 billion improvement, about $1.2 billion I think came from a reduction in credit impairment charges, and they were unusually elevated during the global financial crisis. So I guess the question is, can that sort of increase be repeated?
Well, I mean, an increase like that is not going to be repeated in terms of, you don't get a win like that every year, obviously. But the underlying income growth prior to provisions was also up. Which was the encouraging sign from the results.
In fact, you've increased margins by 51 basis points since 2008, compared to 7 basis points on average by your competitors. Now, Jonathan Mott of UBS says never has a major bank sustained such a margin advantage over its peers in this country. So have you achieved that margin advantage because you've been more aggressively repricing your loans, or because you were not aggressive enough before?
Well, there's a bit of both, I guess. I mean, I think that we have repriced the asset side of the balance sheet fundamentally to take into account the risk that we take. I mean, what had happened prior to the crisis was that risk was not being properly priced, and we can see the result of that. That's why provisions were so high. But there's also the other side of the balance sheet. I mean, you actually get margin from both sides. And the funding aspect of the balance sheet is also very important. And, of course, with our Asian strategy, our push in to be a super-regional bank, we've been able to bring far more liquidity from Asia to support the business in Australia.
I mean, another side to this, the margin advantage you have is that whenever one bank gets that sort of margin advantage, it quickly comes back to the field. Is that going to happen to you?
Obviously, there'll be competitive pressure. There is quite a lot of competition in the market, despite what some people say. And there will no doubt be, pressure for us to reduce margin. I mean, that is inevitable. And, of course, as you go through the cycle, as conditions improve, there will be further competitive pressure to reduce margin, to the extent that will it come back to the pre-crisis type levels? I don't think so, because quite clearly pricing at that time had got out of hand. Money was too cheap, and we saw the result of that.
Yeah, and the other element that's going on now is capital pressure to increase your capital. From regulators around the world. Now, your return on equity in the latest result was around about 14%, 13.9%. 2007 it was 20%. 2006, 20%. But in 2007, your Tier 1 capital ratio was 6.7%. Now it's 10.1%.
Yeah.
I mean, it's an equation, isn't it, between capital and interest margin to some extent?
Well, it's a balance, and quite clearly, you can't go too far up the risk curve in order to get those increasing returns. You've got to get them from a sustainable and good quality business. But if you're keeping higher capital than you had done previously, then obviously the return is going to drop.
Does it mean that, however, that you're never going to get back to 20% ROE?
No, I don't think that that's necessarily the case. I mean, I think that a 15% ROE is probably, about right at the moment. But we have to get better in using capital. We have to adjust some of our business models. And until we're very clear of what the capital requirements are from APRA, and exactly, that has to be quite prescriptive. It's difficult to know what products are actually going to take up more capital than those that don't. And then you're going to have to skew your business to those that are less capital intensive.
The other thing you've managed to do is increase market share in mortgages from 11.1 to 12.1%, and also in deposits. Now, is that thanks to Barbara? Do you think?
I doubt it. I think that the advertising campaign was probably good. I think what we have done in our mortgage area is actually improve our processes, and certainly the operational efficiency of our mortgage area has been better than it was, which allows our turnaround time and the ease of dealing with us for our customers much better. But we're certainly not the cheapest, so we haven't done it on a cost basis.
On the Asian expansion, I mean, obviously to some extent you have to be opportunistic and take what opportunities are available, and I think you're doing due diligence on the Korea Exchange Bank in relation to that, or at least you're reported to be. But what's the grand plan? I mean, do you want to be a deposit-taking bank to get hold of the cheaper deposits that you talked about? Do you want to be a mortgage bank, a commercial lender, transaction bank, all of the above? Will it be one brand? Will it be the ANZ brand?
It'll be the ANZ brand. I mean, that is very much the core of the strategy. It will be across all aspects of banking, but we are starting really in the institutional space. So really, it's covering the institutional businesses and getting that connectivity between the countries, particularly for our institutional business and around the global markets products, really. But cash management, trade finance are all important aspects of that. The next stage is moving that down into the commercial banking space, and we're doing that in countries where we do have the critical mass. And of course, in a number of countries, we also have quite a big consumer business as well, and also private banking. So, and that will develop into a wealth management offering, but that's going to take a little longer. The consumer and wealth side will take time. It takes time to build that up. But yes, it's going to be an important part of the business. And what comes out of that, of course, is an increase in deposits.
And presumably fees and interest margin from... I mean, so it's not just deposits feeding into the Australian bank. No,
I mean, obviously the returns that we make up there, the margins are tight in Asia. It's a tough market, but so far we're doing pretty well.
And just finally, what's your sense of the Australian economy now, how it's travelling? I mean, obviously the news looks pretty good. Is that how you see things?
Yeah, I do. I think that the economy is in pretty good shape, actually. I think it's actually going at a multi-speed, but I would actually consider that normal. I think if you look pre-crisis, we were in an environment where every sector of the economy was doing very well, and we all got used to that. And that's not normal, actually. You'd expect that some sectors of the economy will be going better than others. And right now, obviously the mining and natural resources sector are going gangbusters. The financial services sector is going well. I wouldn't say that that's going as fast.
You would say that, though?
But I would say that. Things like the tourism industry are suffering from a strong dollar. as you can understand. And indeed, the agricultural sector, again, which relies heavily on exports, is also suffering because of the stronger dollar. So, you'll always find that there will be sectors that are doing better than others, but overall it's going pretty well. And we're seeing that with increasing loan demand now.
Thanks for joining us, Mike Smith.
Pleasure to be here, Alan.